Welcome to Industry Focus, the podcast that dives into a different sector of the stock market each day. It's Monday, December 31st. I'm your host, Jason Moser. On today's show, we're going to jump right in with some bold predictions for 2019, courtesy of my main man here, certified financial planner, Matt Frankel, who happens to be joining me today on Skype. Matt, you recovering from this busy holiday season?
I am. I still have family in town, actually.
Well, I mean, that's I guess, that's the blessing and the curse, right? Certainly, it's always nice to have family in town, but it's just a little bit. Those are expectations that you have to live up to, Matt. You cannot miss expectations when it comes to family in town.
Yeah, it's true.
All right.
It makes for a hectic time.
It does, but a good time and one you always remember.
Yes,
so
definitely.
It is the last day of the year. Before we ring in 2019, we thought it would be a great idea today to go back to a piece here that you wrote recently for Fool.com, Matt. This was something you published on December 17th. It's called 5 Bold Predictions for the Stock Market in 2019. I thought it would be fun to go ahead and run through each of these 5. Give us a take on why you think these bold predictions will come to fruition. So let's just jump right in here. Bold prediction number 1. Matt, you're saying the trade war will come to an end.
Yeah, I feel like the fears of an ongoing trade war have been a little overblown. And not only that, but China stands to lose just as much, if not more than we do, by this dragging on past the recently extended deadline, which is actually coming up in not that long from now. And our president, more than any that I can remember, views the stock market as a barometer of his success. All presidents in my lifetime have cared about what the market's doing, cared about the economy, but I don't remember any, bragging about the stock market as a kind of barometer of success. So the president knows that the trade war is kind of putting a damper on the stock market. So I think that the two sides will come to some sort of agreement on especially the issues like IP theft and things like that pretty early on in the year. And I think that'll be a big boost for the market and, the overall just economic climate and the volatility of the market in 2019.
Okay, so I think I'm with you there. I hope that is the case. I hope they do come to a deal here, and I think that in that perspective, that is a positive catalyst for the market in 2019. But we go to bold prediction number 2 here, Matt, and I feel like if prediction number 1 is a catalyst to the upside, your bold prediction number 2 might not be quite the same. And you think that the Fed will raise interest rates. Not a surprise there. But you're saying you think the Fed will raise interest rates not just once or twice, but even more.
Yeah, I get this is not a very popular prediction, unlike the other one.
Especially with what's going on right now. I mean, the back and forth here, it seems like the market over these past couple of weeks has really been moving on not only this call from the Fed, they're going to bump rates maybe twice, but sort of the sentiment, the behind how they're saying what they're saying. I mean, wow, you think more than twice, that could be a problem, right?
Well, you got to understand that based on the latest the dot plot that's released at the end of the last Fed meeting, 6 out of the board of the FOMC directors still think that we're going to have 3 rate hikes. So I'm not alone in this projection.
Okay.
But having said that, I get that this is not popular, especially among the president. But the numbers kind of justify this. Other than the trade war, which is causing some uncertainty. Remember, I'm predicting that the trade war ends pretty soon. Unemployment is still extremely low. Inflation's right at the Fed's target. The economy is strong. I have a feeling this holiday shopping season is going to be a monster for retail and pretty much anyone selling something. So I think that the economy is doing better than, most people are giving it credit for. If the trade war ends like I'm predicting it will, I think the Fed will justifiably raise interest rates a few times in 2019. I'm saying a minimum of 2, I'm guessing 3. So I guess that's a bold prediction. Bold predictions mean that they're not, they're not
consensus.
Certain. Right.
You're going against the grain.
I'm definitely going against the grain on this one, but like I said, I think the economy is better than the market seems to be giving it credit for.
Yeah, I tend to agree, actually. And I think one of the things I've been noting here, and I've said it a few times, is that with all of the volatility that's come from this interest rate talk and whatnot, there are a lot of good businesses out there, and they are really good businesses regardless of the interest rate policy that is making the headline on any given day. So I think it's always worth remembering. I mean, while the reality is that some of this Fed talk will certainly move markets on any given day, and we can't really predict how or when, but that really does play into why we invest the way we do, business-focused investing, because these good businesses transcend headlines like these. They're going to be good businesses next year and the year after, and this volatility, if anything, maybe it gives you an opportunity to add some of those really good businesses. So certainly something worth keeping in mind. And speaking of adding to good businesses, I like your bold prediction 3 here. You think that bank stocks will stage a big comeback.
Right, and this is actually building on my first 2 predictions. To be perfectly clear, I'm not predicting that the market will necessarily have a great year in 2019. The bear market could continue for a little while. But banks, if I'm right that the Fed goes ahead and pulls the trigger on some more interest rates, I see that translating into higher profits on banks. I think the long end of the yield curve is well overdue for a move. And a lot of banks are just trading at like fire sale valuations right now. Goldman Sachs, as everyone knows, is one of my favorites, is trading for less than 80% of its book value. That's where it was trading during the financial crisis.
Wow.
So there are some absurdly low valuations right here. Bank of America is another one that's trading for less than book value now, even after all of its improvements over the past few years. And the earnings boost that all these banks have gotten from tax reform. They're still trading at these low valuations right now. Even some of our favorite small caps, Axos Financial, formerly Bank of Internet, is another one that's trading for an extremely low price relative to where it's been over the past couple of years. So I think that the correction in banks has been way overdone. I think if we get interest rates, it's going to there's a ton of upside potential. But I think even without that, the banks are just pricing in way too much economic weakness.
I tend to agree with you there. I think that, we talked about this a lot throughout the years. These higher interest rate environments ultimately are opportunities for banks to make more on the profit side of the business, right? That can help their profitability. And so, it does seem like a lot of these banks at this point are trading with sort of some pretty pessimistic outlooks, and I guess I understand that in the near term, but really, over the long haul, these are financial institutions. They're facilitating the movement of that money all over the country, all over the world, and I think you made a really good point on the valuations there. You need to be keeping an eye on these banks when they hit those valuations. They don't quite make a lot of sense, and even if that interest rate policy carries on through 2020 and 21. You're still looking at the long-term case making sense for a lot of these banks. And hey, when we get to one to watch later on in the show, I think you'll like what I'm calling out for 2019. All right, bold prediction number 4: Apple will become the largest U.S. company once again.
Yeah. Apple's just a great business that's been absolutely clobbered lately. It's down, I think, something like more than 30% from its highs right now. You remember Warren Buffett's been loading up on Apple. He's been doing that for a reason.
Yeah.
It's because the business is great, not because this next quarter or holiday iPhone sales or whatever are going to be great. Which, first of all, I think holiday iPhone sales are going to come in ahead of expectations.
You think?
I do. I think that the third quarter numbers, or whichever Apple's fiscal quarter was,
right,
but the calendar third quarter's numbers were weak or not great because the new iPhone is at a much higher price point than previous models. So in my kind of my thesis in that is that this is more of a Christmas gift item than just a run out and buy because it just came out item. So I have a feeling that the holiday numbers are going to be a little better than expected for Apple. But regardless of what the holiday numbers come out to be, I think that, with Apple's cash flow, they're buying back tons of stock right now. They're attracting the attention of some big investors, notably Warren Buffett, who has said he would love to own the entire company if he could afford it. Even after the recent correction, that's not going to happen. But
yeah, it's still a big.
I wouldn't be surprised if Buffett's buying billions and billions of dollars worth of Apple this quarter to add to his already enormous position. But it's a great business. I can't name any other business whose customers are as loyal as they are to Apple. That's without the big growth in the service business that's just going to make the whole ecosystem even stickier. And just this drop, because it was triggered by one quarter's worth of guidance and the decision to stop reporting product level sales figures, is crazy to me, especially since the business is generally doing great. So I think it's going to catapult back to the $1 trillion market cap pretty quickly.
Yeah, I think you're right. And it's amazing how quickly that move down came. I mean, in August, I think it was in August of this year, it hit that $1 trillion market cap, surpassed it. And I mean, in short order, I mean, along with everything else, is pulled back. I mean, this now it's around a $750 billion company, which, I mean, that is just a tremendous move in a short period of time for a business that really is doing well in virtually every regard. And to your point about the iPhones and Christmas items, I mean, our girls got their first iPhones this Christmas, so we gave them, or Santa gave them, a couple of iPhone 6S's, which were a great entry-level phone for them, reasonable cost. And so I think it's good that they're keeping a lot of those older models still out there in the market because, hey, my wife and I even upgraded to that new 10, the 10R here recently. And I don't know, it's okay. There's some things I'm not that big of a fan of in regard to it. But, by far and away, the biggest point for me with this new phone is that I've now got a phone where the battery can last all day again. So, if they're able to just keep on making the battery better, then I think they'll keep people coming back for more. And you're right. That's a very loyal user base. So I would not be surprised to see Apple pick back a lot of those losses in no time at all. All right, number 5, final bold prediction for 2019. Warren Buffett will buy something big. I mean, I don't think there's any problem. Everybody probably gets out there and says, yep, he's going to buy something. But you think he's going to buy something big. Tell us a little bit about that.
Yeah, and I'll make this a very bold prediction. I think this is going to be he's going to make his biggest acquisition to date in 2019. I think the biggest one so far was Precision Castparts, a little over $20 billion. He's got over $100 billion sitting in cash, not including whatever cash flows coming in during the fourth quarter. Mm-hmm. So, and he likes to have about $20 billion in reserves. So he's got about $80 billion to spend, a market that's gotten a whole lot cheaper. So I think and I mean, this buying something big could mean he puts $50 billion into Apple.
Yeah.
But so that, I mean, I would consider that a big acquisition, quote unquote, for Warren Buffett. But just to kind of give you an idea, and I mentioned this in the article, Berkshire has enough cash, not including the $20 billion Buffett wants to keep, to buy a company like Lowe's or Caterpillar with just the cash that it already has. And that's not to mention Berkshire's sky-high credit rating that allows it to borrow money at virtually nothing.
Yeah.
Charlie Munger estimated that Berkshire could make a $150 billion acquisition with no problem if it wanted to. And now that valuations have come back down to earth a bit, I could really see that happening in 2019. It's been a while since they've made a big acquisition. Buffett has mentioned that he would love to make a big acquisition, more so than, buying back stock or just buying common stock. He wants to own a whole company. So I think that 2019 is the year that this is finally going to happen. I think you're going to see a big acquisition of some sort from Berkshire. I'd
love to see that. I'd love to see that. I mean, you're right. He's got the resources between between the cash on the balance sheet, the credit rating of the company, and hey, listen, I mean, he can issue stock whenever he wants to. I mean, they've got a lot of different ways to do whatever they want to do, and I'm sure he's probably looking at that and thinking, hey, you know what, maybe his time is a little bit, a little bit on the shorter end for him and Charlie, unfortunately. So maybe they're looking to really make something happen in here in 2019. All right, I like those 5. I'm going to come up with one bold prediction for you, Matt, and this is gonna relate to our finance world that we cover here on Industry Focused Financials, and it's also going to tie into your bold prediction number 4 about Apple. I'm going to make the bold prediction here that in 2019, Apple is going to acquire, you ready, Matt?
Go for it.
Square. Apple is going to acquire Square in 2019. Now, let's be clear. Like we said, bold prediction means you're not going consensus. You're saying something that's, kind of nutty. And do I really think this is going to happen? Well, maybe not. But hey, let's throw caution to the wind here and think about why that might happen. Think about some of the similarities there with Apple and Square. I mean, Square, much like Apple, has a reputation for making very slick hardware that's easy to use, that people really like and are loyal to. And not to mention the fact that Square, like Apple, has done a very good job in developing a software ecosystem built around what customers want, what their merchant customers want, whether it's in restaurants or retail or whatever. I mean, they've got everything from payroll to taxes and inventory management. So I think that, one of the things missing from Apple's business model, particularly as they make this move over to the services side of the world, is they're missing that really nice, sticky, consistent sort of revenue stream that payments offer. And man, I bet you they think there would be an interesting opportunity out there with a company like Square that today, I mean, with the market pulling back the way it has, I mean, as of this taping, Square is around a $22-23 billion company. I mean, Apple could easily acquire it, and just, hey, buy the company and let Jack keep on doing what he's doing. And hey, listen, it wouldn't shock me at all to see it happen. I think that Apple's looking for new ways to put their money to work. And you and I think both agree that payments are a great space.
That's true. Apple's been trying to get into payments. They have the Apple Pay Cash person-to-person app. They can integrate that with Square Cash pretty easily. And wasn't some of Apple's or Square's original hardware developed to work with the iPad?
Yeah, I mean, that's the other thing is you see everywhere you go. If a merchant's using Square, I mean, they flip over that thing where you can confirm the purchase and add a tip and whatever. I mean, their hardware, it seems like, was built for Apple equipment, and I mean, it just there's so many similarities there. It just seems like they would be two companies that would work very well together. But I mean, hey, I guess we'll see. I mean, I guess really selfishly, I hope it doesn't happen because as a Square owner, I mean, I'd like to see this company grow on its own. I mean, I think there's a multi-bagger opportunity there, but it wouldn't shock me if Apple wasn't at least kicking the tires on that thing and trying to figure out a way to bring them into their family. So I guess, 2019 will tell us all we need to know in regard to our bold predictions, Matt. Okay, let's jump into a couple of questions from Twitter here to wrap up the year. We had one question, speaking of Square, a question from Twitter at theanimal23 tweeted us and wanted to see if we could elaborate on the benefits and our thoughts on Square reapplying for the bank charter. And, Square, we know they applied for a bank charter a while back. They withdrew that application just for procedural reasons. They didn't feel like they were quite ready for it. They have reapplied for this bank charter. Matt, what did you see here? What do you think about that?
I mean, I like the move. A lot of investors in the market seems to just kind of feel this way. There's kind of a mixed bag here. On one, a lot of people see this as increased unnecessary risk, kind of the way when they announced the Square Installments platform, where they were getting into consumer lending for the first time. Getting into being an actual bank, a lot of people see as kind of opening the door to a lot of unnecessary risk. On the other hand, it also opens the door to a lot of growth potential. Initially, I know they just kind of want to make small business loans, just like they've been doing through Square Capital, just kind of cutting out the middleman, which will save them some money. But this is also the avenue to get into real, like, the personal lending space and to do the Square installments without a middleman. So it does add a little bit of an element of risk, but it also adds a lot of reward potential. So I'm all for cutting a company's costs, especially when they're still trying to become profitable. So this is a way to increase the Square Capital's margins, and to open the door to a whole lot more growth in the future. So I'm for it. It definitely does add a bit of risk, but I think it's well justified.
Yeah, I think you're right. It gives them more opportunities in the future. Certainly in line with the Square Capital side of the business, and it's not unheard of for this to happen. I mean, American Express back during the days of the financial crisis became a bank holding company as well, right? I mean, that was a little bit of a different situation, but I mean, it was still ultimately they've pulled it off quite nicely. So. Yeah, I agree with you. I'm for it too. Now, one other tweet here we got the other day, and I actually thought this would be, instead of replying on Twitter, I really thought this would be a great one to bring over to the show here. It's from @Andy Wolfarth, and Andy asks, Berkshire Hathaway A and B shares are the largest holdings of Markel. If I want to pick up just one of these at this opportune time, does it make sense to just get Markel? And this, I think you and I both have a couple of thoughts on this one, Matt. But what's your first impression here? Berkshire Hathaway, Markel, own one or the other or both?
It just kind of depends on your risk tolerance and what you're looking for. I don't think you would go wrong with either of them. Berkshire is by far the bigger, more established business and is designed to just steadily increase its intrinsic value over time and produce market-beating returns over long periods of time. Markel is is the younger of the two, definitely more specialized, much more of an insurance play than Berkshire is at this point, and has a lot more growth potential. So Markel would be kind of the one for investors with long time horizons. I mean, I'm planning on holding my shares for a few more decades to kind of let the growth story play out. I'd be comfortable holding Berkshire for 5 years, whereas Markel I'd want to hold for 20, 30 years.
Yeah.
So depending on your time horizon and risk tolerance, I'd say that's kind of what dictates your decision. Lately, I've bought more Markel than Berkshire, so there you have it.
Yeah, I'm glad you mentioned that time horizon there, the 5 years versus a few decades. Speaking from personal experience here, earlier this year, I had a modest Berkshire Hathaway position, the B shares that I'd held for a number of years. I mean, and the stock had done very well for me, and it was one of those ones that I could just sort of ignore and I knew it was going to be okay. But earlier in the year, I liquidated that entire Berkshire position, and I put those proceeds into more Markel. And I think you really hit the nail on the head there when you talk about the difference between the two companies from a timeline perspective. Now, you look at Berkshire Hathaway, it's around a $500 billion company today, or close to it. Markel is like a $13, $14 billion market cap, much, much smaller. And as you noted, obviously a lot of room to run there. Still more of a specialty insurance business, but they are growing and expanding and offering more things beyond that. They've rolled in some acquisitions that are working out well. And the one thing I've always enjoyed about Markel is that Tom Gaynor, the chief investment officer there, is the co-CEO there actually now. He's had a very he's had a little bit more of a propensity to invest in tech. And so you look at their holdings, and yes, Berkshire Hathaway is a big holding in the portfolio, but they also own Apple, they own Alphabet, they own Amazon, some of those companies that Buffett has steered away from for a while because he felt like he didn't really have an edge there. Activision, Blizzard. I mean, these are all companies that are in Markel's portfolio today. And I think that, yeah, Markel's one that I'm going to plan on holding for the next probably 30 years. So I'm really happy to continue owning those shares. It was less a knock on Berkshire and more about the opportunity that Markel, in his Andy noted in his tweet, you own Markel shares, you are getting some good Berkshire Hathaway exposure through their investment portfolio as well. So Andy, hope that was helpful. Okay, Matt, let's wrap this thing up here. We've got one to watch, and as always, we're talking about one to watch for the coming week. week. We thought it'd be fun this week because of the date here. We're getting ready to roll into 2019. Let's see if we have one to watch here for our members and listeners in 2019. Stock that you feel like is poised to have a good 2019. What is your one to watch for the coming year?
Mine is Square, and not just because you said that Apple's going to buy it. I think Square could have a great year. If you remember, Square hit $100 a share this year, which is about double where it is right now. And the reason is because not only has Square been growing at a crazy rate, but the growth has been actually accelerating, which is really kind of great, being how big the company's getting. So I think if Square's earnings continue to, or not earnings, if Square's revenue continues to accelerate over the year, regardless of whether or not the company's profitable, I think we could see it easily double from the current levels and regain a three-figure price tag. I
think that's a reasonable prediction there, man. I think I'm going to hang on to my shares. A lot of good thoughts there. I am going to go with a company listeners have probably heard on this show a couple of times before, Ameris Bancorp. Ameris is just a little bank down in Southwest Georgia, headquartered headquartered, I think, actually technically out of Jacksonville, Florida now, but its roots are in Moultrie, Georgia. And it's a bank I've covered for the better part of about eight or so years now. And Ameris flew under the radar here recently, but Ameris announced a big acquisition. I mean, this is such a big acquisition. It's kind of more like a merger, but they're going to be acquiring Fidelity Bank of Atlanta and bringing this Fidelity Bank into the Ameris family. It's about a $750 million deal. And when you put that in context of Ameris's $1.5 billion market cap, you can see it is a big acquisition. They made the announcement, and of course, as is often the case, the market sold off shares of Ameris, basically saying, hey, the burden of proof is on you now to justify this acquisition and prove that it makes sense. Now, I think that it does make sense, and Ameris Bancorp has a good track record of acquiring and bringing in smaller banks to their family and growing that business all the way back to the financial crisis when the FDIC saw them as a healthy partner to help them sort of wrap up some of those failed institutions, and consequently, Ameris has grown considerably since then. Not just the market cap of the company, but its total asset base, deposit base, and really this deal, it is going to give them an attractive a total asset base of over $16 billion. They're going to grow their deposit base to over $13 billion. And it's also worth noting that the additional deposits they're bringing in from this Fidelity acquisition, they're a lower cost deposit base, about 25% lower cost deposit base. And really, that's what banks do, is they take that deposit base and they invest it a lot of different ways. And Ameris has a good track record of doing that. So I think that the sell-off in shares, while understandable, I think it's short-sighted. I think if you can look at this bank and think about owning one for the next 5 years, I mean, this is going to be a really attractive risk-reward scenario here. And to be clear, I own shares. And I did buy a few more shares after the announcement of this acquisition because I really think there's a lot to like here. So ticker for Square, SQ, ticker for Ameris Bancorp, ABCB. For the listeners out there, keep an eye on these for 2019. And Matt, we will revisit them periodically throughout 2019 to let our listeners know exactly how they're doing, right?
Absolutely. I'm sure you'll hear us talk about both of those several times.
All right, man. Well, Matt, listen, I tell you, I've had a great year here with you on the show. I appreciate everything that you've done for me and for our listeners. It's been a lot of fun, and I'm looking forward to what the new year has to bring us.
Absolutely. 2019 is going to be our best year yet.
All right, folks. Well, as always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. This final show of 2018 is produced by our guy, Dan Boyd, behind the glass. Dan, thanks for coming in today. Have a great 2019. For Matt Frankel, I'm Jason Moser. Thanks for listening. We'll see you next year.